Ladies and gentlemen, good day and welcome to the Q4 FY26 earnings conference call for Batliboi Limited, hosted by Go India Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Saloni Ajmera from Go India Advisors. Thank you, and over to you, ma'am.
Good afternoon, everyone. On behalf of Batliboi Limited, I would like to welcome you to our earnings call to discuss the operational and financial performance for the fourth quarter and fiscal of FY26. The session is being hosted by Go India Advisors. Joining us from the management team of Batliboi are Mr. Nirmal Bhogilal, Chairman, Mr. Sanjeev Joshi, Managing Director, Mr. Kapil Arora, CFO, and Ms. Pooja Sawant, Company Secretary. Please note that today's discussion may include certain forward-looking statements which are subject to various risks and uncertainties. I encourage participants to consider these factors when interacting in company developments. With that, I now invite Mr. Bhogilal to provide an overview of Batliboi's business outlook and performance for the fiscal. After his remarks, the floor for Q&A. Thank you, and over to you, sir.
Good afternoon, everyone, and thank you all for joining us today for Batliboi Limited's earnings call for the fourth quarter of FY26. It is with pleasure that I address you reflecting on the journey of Batliboi for FY26 and our preparation for the upcoming fiscals. We appreciate your continued interest and support, and I trust that you had the chance to review our investor presentation, our financial results, and the press release, which are all available on the stock exchanges. In its April 2026 India Development Update, the World Bank projects India's real GDP growth at 6.6% in FY27, reflecting moderation amid elevated energy prices. Yet India remains amongst the fastest growing major economies globally. Even as the West Asia conflict weighs on market sentiment, our growth trajectory stays resilient, supported by strong domestic demand and sustained manufacturing momentum that cushions against external shocks. A growth-oriented budget with higher government capex, while maintaining fiscal discipline, progress on FTAs, reduced US tariffs, and supportive domestic policy measures will further bolster this outlook, aided by stable investment flows, ultimately facilitating a gradual recovery in the economic growth driven by demand. Over and above, our Prime Minister recently has spoken out about the challenges facing our country. He emphasizes on us furthering our need to be more self-reliant, especially in the areas of energy, defense, and strategic products that are currently being imported. This augurs well for the capital goods industry and will therefore benefit our company as well. At Batliboi, we continue to strengthen our core through consolidation of our groups and building partnerships to navigate external disruptions effectively, closing the year with a favorable performance. Going forward, there will be substantial challenges, including uncertainty from evolving US economic policies that could reshape global dynamics, elevating Asia's significance and transforming Europe's role in the world order. Amid escalating global conflicts, demand for industrial machinery is expected to scale to unprecedented levels. We fully grasp the enormity of these shifts and are committed to realigning with these economic and business dynamics while staying true to our customer-centric ethos. Notwithstanding any further adverse impact, if any, on the global and Indian economy in the event of a prolonged conflict in the Middle East, we enter FY27 with confidence. The best years for Batliboi lie ahead. Batliboi's machine tool division leverages state-of-the-art facilities and technological partnerships to serve diverse industries, including automotive, aerospace, die and mold, pumps and valves, oil and gas, and industrial machinery. The global CNC market valued at US dollars approximately $95 billion in 2024, with Asia Pacific holding a 55% share, is projected to grow from $101 billion in 2025 to US dollars $195 billion by 2032 at a CAGR of 9.9%, even amid geopolitical tensions. This augurs well for our Quick Mill business. Our Canadian subsidiary Quick Mill has reported robust performance, and with a healthy backlog order at year-end and focus on export markets, will improve its performance in FY27. India's CNC machine market has also shown resilience, supported by strategic shifts and government backing, with the overall machine tool sector expected to expand by US dollars $3 billion at a CAGR of over 11% from 2024 to 2029. As mentioned earlier, the focus on self-reliance augurs well for this industry too, and we remain committed to sustaining profitable business growth for our machine tool division over the foreseeable future by also expanding our product range. Our textile machinery division serves both Indian and international textile sectors, standing at the forefront of developing machinery with a steadfast emphasis on precision, efficiency, and reliability. With each significant milestone, the division has augmented its presence while consolidating its foundations in India. Despite strong sectoral headwinds, the revival of the textile sector is poised to drive increased demand for textile machinery. We have faced challenges during the current fiscal year, under the fiscal year under review, with the partners abroad both in knitting and spinning, as they have been undergoing major restructuring and realigning of their business. However, these challenges have been overcome, and we are looking forward to further exploiting the increasing demand for textile machinery. The Environmental Engineering Group, which was formerly Batliboi Environmental Engineering Limited prior to the merger, drives business through its air pollution control, gasification, industrial fans, and emerging green hydrogen segments, delivering 100% Make in India solutions as a leading provider of air pollution control equipment and fan systems for key industries like steel, power, oil and gas, sugar, cement, and solar equipment manufacturers. Our Indian subsidiary, Bioconserve Renewables Envirotech Private Limited, which is now only a year old, continues its focus on zero liquid discharge solutions. We see immense potential here and are targeting major new zero liquid discharge projects in the upcoming fiscal. ETP upgrades and O&M contracts will also generate profitable opportunities. Textile, engineering and process industries, our core client base, are the highest water consumers, providing us easy entry and helping us position as a long-term environmental solutions partner, not just an equipment supplier. To conclude, amid the complex shifts in the economic and business landscape, Batliboi stands as a dynamic, adaptive organization, resolute in overcoming challenges. We endeavor to deliver customer-centric solutions with unwavering focus, leveraging our proven expertise to secure these objectives. This journey demands nothing less than hard work, focus, and execution excellence from our side, and we count on your steadfast partnership as we enter FY27. I now hand over to Mr. Sanjeev Joshi, our Managing Director, to share the operational and financial update for the quarter. And after that, all of us, including our CFO, will be available for the Q&A. Thank you very much.
Good afternoon, everyone, and thank you for joining us today and showing continued trust in Batliboi. I will now walk you through Batliboi's financial and operational performance for the quarter for each division. In FY26, we delivered a 7% growth in top-line revenue, reaching rupees 440 crore, while successfully maintaining stable EBITDA margins despite meaningful headwinds from global supply chain disruptions and broader macro uncertainty. We recorded a PAT of around 7 crores. However, our bottom line growth was impacted by two main non-recurring items. First, provisioning necessitated by our 4 new labor codes notified by the Government of India in November 2025, and the accounting impact arising from the merger of Batliboi Engineering Limited with Batliboi, which was completed in Q1 FY26. We view these as one-time adjustments that do not reflect the underlying earnings trajectory of the business. Our performance was driven by improvement across all business segments despite challenges faced in the textile sector. Our efforts continue to drive strong order inflows. As of March 2026, our order backlog stood at approximately 593 crores, and we recorded order inflow of almost 990 crores in FY26. We have incurred a cumulative capex of 27 crore in FY26 and plan to close FY27 with an additional capex of around rupees 10 crore. On the balance sheet, we continue to deliver on our deleveraging commitment with our debt to equity ratio now compared to 0.28x, a level we intend to sustain going forward. I will now quickly run over the performance divisions as under. The machine tool division recorded an order inflow of about 60 crore in quarter 4 FY26, with a total order backlog of this division reaching 163 crore as of March 2026, accounting for 27% of the company's overall order backlog. We successfully installed 115 machines that were produced in our Udna factory in machine tool manufacturing division. Quickmill reported a turnover of rupees 35 crore in quarter 4 26, with achieving a revenue of rupees 127 crore for FY26, demonstrating a solid performance in operational strength. The Air Engineering Group reported a revenue of rupees 17 crore in the quarter, and for FY26, revenue stood at rupees 57 crores, accompanied by an improved order inflow of about 17 crores in the quarter and rupees 67 crores for the whole year FY26. The Textile Machinery Group had an order inflow of rupees 38 crores in quarter 4 of FY26 and rupees 435 crore for whole year FY26. Order backlog stood at rupees 238 crore. Textile Machinery Group reported a revenue of 50 crore in FY26, out of which rupees 13 crore was recorded in Q4 of FY26. The Environmental Engineering Group reported order inflow of rupees 17 crores and a revenue of about 35 crores in the same quarter. With healthy order backlog of rupees 82 crores, this division too expects an improved performance for the full year. I am confident that Batliboi will deliver improved and stronger performance in the coming quarters, building on the momentum we have established. I am further confident of an improved result both in top line and bottom line in FY27. With our strategic initiatives, robust order book as on end of March 26, and focused execution, we are well positioned for sustained growth. However, this is subject to not having any further impact, if any, on the global and Indian economy in the event of a prolonged conflict in the Middle East. Thank you, gentlemen. I now open the floor for any question answers we may take as a team.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and then 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Again, to register, please press star and then 1 now. Participants, you may press star and then one to ask a question. The next question comes from the line of C.A. Shaishav Vora from Financial Planner and Wealth Advisor. Please go ahead.
Yeah, good afternoon, Sanjeev, and good afternoon, Mr. Bhogilal.
Good afternoon.
Just a couple of questions. One is, that about the Bioconserve Renewable Environment Private Limited company that you have. What are the plans for 26, 27? I mean, the projection, sales, margins, profitability?
Well, all I can say is that the performance will be better than what we have achieved this year. And as you're aware, it was the first year of operation, and we have been I think we've turned in pretty good profits. So we expect to improve that on this year. And we also see a very good demand for our products and services in the market.
Okay, so second question, sir, we have spoken about the green hydrogen in our earlier presentations also. So what is the status on the same? Where are we in that business? Have we signed any MOUs with any prospective customers?
Yes, Mr. Vora, we had a balance of payment MOU signed with L&T in a very nascent stage. We are pursuing 2-3 very active inquiries in terms of balance of payment and also the electrolyzers. We have signed an MOU with Chinese equipment manufacturers a couple of months back. So right now we are chasing and pursuing some active 2-3 inquiries which we hope that in this next 2-3 quarters we should be able to do something about that. Okay.
Okay, sir. Thank you. The last question. I've seen that the debtors have gone up compared to the last year. So my only question was that how much of the total debtors is export debtors, and of the export debtors, what is the export debtors pertaining to Bangladesh? Because the situation what it is in Bangladesh, are we covered as far as the outstandings are concerned?
Zero data now.
No, all our business, export business is covered under letters of credit.
100%.
So there is no question of any bad debt in exports. As far as domestic is concerned, the payment depends on the payment terms depend on division by division, and as our business in our environmental engineering group increases, we will see an increase in debtors in that area.
Okay, sir. Thank you. That's it from my side.
Thank you. Your next question comes from the line of Krish Dalal from Concept Investwell. Please go ahead.
Good afternoon, sir.
Good afternoon.
Good afternoon.
So my question was, we are seeing some vital signs of revival in the textile sector, and this will create some kind of demand for machinery equipment. Are we planning to launch any new products or maybe going to tie up with any new agency?
Well, this is a continuous process in our company, looking at new products, new agencies, new tie-ups, which would improve the efficiency of the textile industry. So this is a continuous process, and it goes on irrespective of whether the textile industry is in a boom situation or in a static situation. And we are always looking, all textile mills are looking at improving their efficiency, both efficiency in labor productivity as well as in energy efficiency. So both these areas we are actively working to introduce newer products to improve in these areas.
Okay.
And as you're right, the textile industry is going through a much better phase than what it was, say, 12 months ago.
Yes, sir. So moving ahead, what are the plans for quick mill for this fiscal? Has the demand condition improved for quick mill and Canada in particular?
Yeah, in fact, I'm happy to state here that quick mill had a very phenomenal performance for the last fiscal. And looking at the orders on hand as on 1st of April, we will be delivering a much better performance for FY27. And with the more focus on export markets outside North America, we are very sure and confident that we'll be definitely improving our performance going forward for quick mill.
Okay, sir. So, for the last question, what are our expansion plans for biocontrol renewables? Have we won any order or contract? Do we have a dedicated team? How are we planning to expand the business?
Yeah, I will just answer you that. Look, this, as our chairman said earlier, this is the first year of operation, and we have done better than what we had projected for. Going forward, we would like to now consolidate our business position in the textile ETP market. And then as things move forward, we have a subsidiary which have a separate team of sales, O&M people. We take O&M contracts. Once we are quite well established in this textile business, we can then look for a further industries to cater to.
Okay, sir. Thank you.
Thank you. Before we take the next question, a reminder to all the participants, you may press star and then one to ask a question. The next question comes from the line of Prashant Kumar Uttamlal Hazari, an individual investor. Please go ahead.
Hi, good afternoon, sir.
Good afternoon.
Yeah. So, my question is like, our order backlog is not matching up with its reported numbers, right? So last year we had an order backlog of 339 crores, right?
Correct.
This year we have received order of 988 crores. We did revenue of 440 crores. So order backlog should be 887 crores, but we have reported 593 crores, right? So why there is a mismatch on this?
See, the mismatch is because our revenue reported does not take the indirect sales into our books. So only the commission on the indirect sales is shown as revenue, whereas the order booking and the order backlog reflects both the direct business and the indirect business. That's why there's a mismatch. But confidently to say that our order backlog has improved dramatically compared to what it was last year. From 339 crores, we are talking about nearly 600 crores.
Yeah,
I hope that answers your question.
Yeah, that exactly, that is what I was. But is it possible for you guys to like bifurcate these two kind of orders? Like so the investors should have complete understanding of the order backlog, right? So
I think if you look at our quarterly published statements, at the bottom we do put a figure of the total business handled. It shows both the what is reported as revenue as well as the indirect business at the bottom of the second page of our LRS.
All right. Okay, I will look into this, and if I have any question, I will get back to it.
Further clarifications, Mr. Kapil Arora is available to answer your question or provide any further clarification you require.
Yeah, sure. So my second question is like, with current plant capacity, right, what we have, what kind of revenue we can generate?
Which plant capacity?
Whatever, like we have plants like textile, so what kind of revenue we can generate from the same capacity without any capex?
I think, as far as the machine tool division at Surat is concerned, we have invested, as you're aware, the bulk of that 27 crores has gone in that division. And we started getting the benefits of that investment from the fourth quarter onwards. So as you can see, going forward, we have enough room for getting a much better revenue out of our machine tool division with the investment made. As far as the textile air engineering plant is concerned, the focus is improving productivity, improving quality, improving finish, so that we are competitive in the export markets. And that is our more focus rather than, and the volumes, if we get the export business that we expect to, the plant capacity is sufficient to take care of it.
All right.
Okay, and as far as Quickmill is concerned, Quickmill is running at the moment neck to neck. And we have planned an expansion over there. But as you're aware, maybe you're not aware, that in Canada, the bureaucracy is perhaps as bad as or worse than ours. So we are waiting for permissions from their municipal corporations and the local city government for this expansion, which we hope we will get in the next 2 quarters. So with that, we will then go ahead with the expansion of Quickmill plant.
All right. So what kind of capex we are planning in Canada?
In Canada, it will be something in the region of about 4 million Canadian dollars, which is roughly about 25 crores.
Oh, 30 crores kind of thing, right? So, okay. So we have operating margin of around 7%, right? So I can understand that textile machinery will be like kind of commodity product, but like with this environmental engineering and all this stuff is coming into the picture in our company, right? So how do we see our operating margin going ahead? Because 7% is like it's a very small operating margin. We don't have any, like it's kind of commoditized kind of operating margin. So is there any plan to improve our operating margin?
There will be, because as we increase the volume, the operating margin automatically will improve, because we are not focusing on any major overhead expansion.
But are we doing anything about like operational efficiency, improving in our operational efficiency, or we are perfectly
I
there?
think that's a continuous process in any engineering company as to how to improve the efficiency at the plant level, whether it is through better equipment, better tooling, etc. And as far as our offices and marketing and other areas are concerned, I think with all these new tools of information IT and AI, etc., we will definitely improve our operating efficiency.
Well, since 4 or 5 years, we haven't seen any improvement on this. That's why I have this question. Because with improving of order backlog and all this stuff, right? So, and we have done so much of restructuring kind of thing in our company. So, I think it's the time to catch up with the operating margin.
Sure, I agree. But maybe one day you can visit our plant and I think Sanjeev and the team there will show you what kind of improvement has taken place.
Yeah, sure. So one thing is like GMM Pfaudler company, right? In Anand, right? So when they were passing through this kind of thing, right? So they were turning around, because I was investor in that company too, right? So when they were passing through this kind of like a phase, they have hired external agency to look into the operating efficiency, right? So are we looking into this kind of like if we can hire someone else from outside for 6 months kind of thing, and they can provide us some.
In our fan manufacturing, we've already done that exercise.
No, but in overall company kind of thing, we can do that.
I think we have focus on the sector-wise, depending on where the expertise is that suits our sector.
Right. So have you seen any improvement in fan division?
Yes, absolutely. And you will see it also in I think it's difficult to say, but our production capacity in the fan division has increased by nearly 40% this year.
No, but what is the quantum of operating profit parameter, right? Because at the end of the day, it comes to operating profit only, right? And investor understand it.
I agree, but we are not giving you, we don't give information on division-wise profitability.
No, I'm not asking about, but what,
But automatically,
what kind of...
if you see the results, there are certain sectors which are down, there are certain sectors which are up. The textile sector was down last year, but other sectors were up. So it's very difficult to say, and obviously the sectors that are up is because operating efficiencies there have also improved.
Right, but at the end of... all right, so that's it for this. Thank you.
Thank you. Your next question comes from the line of Vedant Mehta from Finstock India. Please go ahead.
Hi. So when I compare Batliboi to our peers, our performance has never been of that scale as compared to peers. Where is it that we are lacking, and what are we planning for the same?
Which is a peer? Sorry, which companies compare us to? Because, we are there are not that many companies which are in the same areas that we are. Maybe there are companies which are in machine tools, there are companies which are in textile machinery, there are companies which are in environmental engineering, but we hardly come across companies which are on all these sectors. So, what do you compare us to?
For example, Jyoti.
Sorry? Jyoti. But Jyoti is only a machine tool company. It's only a machine tool company. So we have to look at Jyoti vis-a-vis our machine tool business. And I agree with you that Jyoti is much larger than us in machine tools. It is today the largest machine tool manufacturing company in India. And also they have a subsidiary in France. Now, we also have a subsidiary in Canada, but we have not been able to bifurcate their French operations and the Indian operations. Everything is combined. But definitely, Jyoti has a much larger product range and a much larger volume than what we
do. Okay. And we're seeing some vital signs of revival in the textile sector, and this will create some kind of demand for machinery equipment. Are we planning to launch any new products, or maybe going to tie up with any new agency?
I just explained to the earlier gentleman that we are always on the lookout for new agencies in the textile machinery area, which would focus on the growth sectors in this business. And the growth today in India primarily is on the processing side. India is going up the value chain from spinning to weaving to or knitting to processing. So we see, in fact, our business of processing is in a pretty high growth phase. And therefore, we went into this whole area of zero liquid discharge, because that's another area, with increasing processing capacity being built up, there is a need to conserve water and a need to recycle water. The second area that we're looking at is where we can provide tools for improving efficiency in the textile industry in terms of operator efficiency, or whether it's quality, etc. So there too, there are some very specialized companies abroad which provide these services and equipment for these services. So this is a continuous process. As I said, we look at this kind of continuous look out for new products, whether we manufacture or we represent, irrespective of the state of the industry.
Okay, thank you.
Thank you. Participants, you may press star and then 1 to ask a question. The next follow-up question comes from the line of Prashant Kumar Uttamlal Hazari, an individual investor. Please go ahead.
Hello. Thank you for the opportunity. I have one question, like on slide number 18, strategic initiative, we have first point that tapping the opportunity in the CNC space, right? So I would like to know what kind of plans we have in this.
Sorry, I didn't quite hear you clearly. In which space?
We are like tapping the opportunity in CNC space, machine tools, right? So what kind of plans we have in this CNC space?
You're referring to page 18, am I right?
Yes. Strategic initiative.
Acha, in the CNG space.
Yes.
Basically, when we are saying tapping the opportunity in CNC space was, if you know about anything about machine tools, the CNC space is very large. The product that we have are hardly 2 or 3 products. So we are in the process of adding our product basket by a new design of machines. So what we are necessarily saying is that to get a better top line growth, we are improving our product basket offerings to the CNC machine tool industry, the auto sector and everybody. And that was again a continuous process. So what we are trying to say is that if we have 2 range of machines or 3 range of machines, we are adding 1 or 2 machines every year to improve our product basket, but thereby improving our top line and the bottom line. Okay.
All right. So currently, how many machines how many types of machines we are making this?
Yeah. So presently we have 2 main platforms on the CNC machines that we manufacture. One platform is the turning centers, and the second platform is vertical machining centers. So there are other 2 products which we are now working on to add to this product basket, which will get a better breadth in the market.
All right. Thank you.
Thank you. A reminder to all the participants, if you wish to register for a question, please press star and then 1 now. Participants, you may press star and then 1 to ask a question. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
So thank you everyone for your participation in this meeting and showing your interest in our company. I hope that we've answered all your questions, and in case you have any further questions or further clarifications, please do not hesitate to contact either our company secretary, Pooja, or our CFO, Kapil Arora, or Sanjeev Joshi, our managing director, or me for that matter. We are all available to address all your queries and address all our valued shareholders. Thank you very much, and hope you have a good afternoon and a good evening.
Thank you, members of the management. On behalf of Go India Advisors, that concludes this conference. Thank you everyone for joining us, and you may now disconnect your lines.